Good morning. This is Miles with Art Jetter and Company. Thank you, folks, for joining us here with Rick Cordero from Principal Talking Disability. We are just going to sit tight just for a few moments as we let the rest of the attendees roll in. So let's just sit tight and we will start the webinar here soon. All right, thanks for joining us. As you have questions, please type them in the question box on your control panel at the bottom right side of your screen. We'll answer them at the end of the presentation. After the webinar, please give me a call to receive a copy of today's webinar and answer any additional questions that you may have. Thanks again for joining us. Rick, take it away.
Thank you very much, Miles. I appreciate it. Well, like I do most of my meetings, I like to ask everybody, where would you like to swim? What I mean by this is, I think what you're going to get from this is there's a lot of opportunity, both for your career and your bottom line, dealing in the income protection, probably more so the risk product marketplace. But I kind of use this as a visual. If you look at this, what swimming pool would you rather be swimming in? The right swimming pool or the left? And most people choose the one on the left. But let me kind of explain my my madness here. The pool on the right, based on a recent study by an independent research firm, found that 95% of people, of individual advisors within the advisors, market. Now, these are people who work in bank channels, broker dealers, financial service industry, insurance agencies, you name it. Anybody in that financial service industry, 95% of them will identify when they first meet an individual, when asked, what do you do? Those individuals will identify as asset gatherers, basically trying to acquire assets under management. The people on the left are those who identify as traditional life insurance agents, and that's about 5% of the marketplace of the people in the financial service industry. Now, one of the things that I found, and by the way, the ones on the left sell disability income, life insurance, and all other forms of financial services. The study went on to say that of the people, when you compare the 5% of those individuals in the life insurance business or the risk management business compared to those in the asset gathering or assets under management business, the people on the left, number one, were in the business longer. Number two, they had a longer relationship or persistency with their customers. Number three, overall, they made more money. And number four is that they had more assets under management than the group on average in the right. So if you're looking to, if you want to be in the financial service industry business, think in terms of risk products, life insurance and disability income, because obviously there's no downside, knowing that you're going to be in the business longer, knowing that you're going to have greater persistency with your customers, you're going to make more money, and you'll have more assets under management than your counterparts who are solely working in the asset gathering business. So let's talk about the financial foundations. What we all do is, as we get started in our careers and graduated from college, and we're buying cars, and we're buying homes, we're getting health insurance, we're getting life insurance. So then as we progress through our career, we're also starting to create retirement plans, personal investment savings, and for many, it could involve business ownership. And as we come to the twilight of our lives, we start thinking in terms of passing on those assets through legacy planning, giving the money to the kids, the charities, or whatever. But one of the things, in order for this home to survive, is that all the things that you plan to do and all the assets that you want to maybe hand off to the next generation are based on one thing for most people, and that's their ability to get up every day and earn an income. Because without an income, then this whole foundation is gone, and this planning pyramid or planning house, if you want to call it, will tumble. I mean, it just doesn't work. And when you consider the odds, let's consider the odds of becoming disabled before age 65 as compared with many other common risks. And these are based on the Society of Actuaries and the National Safety Council. The odds of dying prior to age 65 are 1 in 106. Your home catching on fire, 1 in 88. Being involved in an automobile accident, 1 in 70. And the probability of a disability occurring, 1 in 7. Now, let me identify what a disability is. It's not just a headache and you're not going to work. We're talking about a situation that will last at least 90 days and continue for, on average, 31 to 34 months. Okay, so we're not talking aches and pains and what have you. So when you look at the numbers and you look at how people manage risk, we all buy car insurance, we all have homeowners insurance, we all try to obtain some degree of life insurance. But what about the one thing that's so important to individuals, and that's their ability to get up every day and go to work? The numbers don't lie. This is real. 1 in 7 is a pretty significant chance of something happening. But what does your income do for you? Okay. And what I like to do is setting aside all moral issues. Income defines a person. It defines the home they live in, defines the educational opportunities for their children. It defines their hobbies, their health, the food they eat, the entertainment they enjoy. The technology today is becoming more and more important. We know that the people who are disabled, not able to work, their reliance on technology grows. It gets bigger and more expensive because that is their window to the world. And obviously entertainment, maybe buying gifts for graduating cousins and aunts and uncles' birthdays and weddings and all these other things, they don't go away. You're still part of a culture that has a lot of maybe requirements on you to participate in these things. So when you look at an individual's income, don't so much focus on the dollars and cents. Focus on what it is and what they do with their money and the things they enjoy, such as the home and the car and the vacations and all these things. These are important to them. So instead of just focusing on dollars and cents, focus on what the money does, okay, and what it means to the family and to their livelihood and their dignity in what they want to achieve. So when a lot of times we work with advisors who obviously have balance statements for customers, and they basically take a look at their balance sheet and say, what is it worth? What is it? The car is worth $35,000, the home is worth $290,000 or whatever it may be. But when you look at income, take a 35-year-old who's earning $75,000 a year, and with modest increases. By the time they reach age 65, that's going to be a cumulative amount of income of a little in excess of $5 million. So what I suggest you do is you capitalize the value of their income to age 65 and put that on their balance sheet and show them, okay, you're protecting your car, which is a $35,000 car. You're protecting your home, which is a $300,000 home. Now you've got a $5 million asset here, and it's actually in your shoes. It's your ability to get up every day and go to work, because I can talk to you about retirement plans. I can talk to you about your 401k. I can talk to you about your education for your children. I can talk about a 529 plan. I can talk about saving for the vacation home. I can talk about all these things, okay? But there's one thing that has to happen for my plan as an advisor and your plan as a consumer. For that to work, it has to, you basically have to guarantee that you're going to get up every day and go earn an income. And we know that 1 in 7 people are not going to be able to fulfill that promise to themselves. So when you look at the probabilities and the likelihood of becoming sick or hurt, which are far greater than the things they insure, such as the home and the car, take a real strong look at the customer and really have a very frank conversation with them. And, it is Disability Income Awareness Month. And the operative word here is not disability income, it's awareness. Having your customers be clearly and become clearly aware of the risk of losing their income and bringing to them a solution, okay, which is so important. Then it's never about money, it's never about premium. It's about how important is your income to you and your family, knowing that the likelihood of you becoming sick or hurt is greater than any other risk that we face. Because in our business, in the financial service industry business, we really focus on 3 risks. Number 1, the risk of dying too soon. That's life insurance. The risk of living too long. That is our investments and retirement plans. Or the risk of becoming sick or hurt and losing your income. Those are fundamentally the things for people who are in their working stage of their life. That's the only things we can do for them. No matter what you say you can or can't do, it really focuses on living too long, dying too soon, or becoming sick or hurt. And so this should constantly be something as a part of your conversation with your customer. And if you capitalize their earnings and put that on their balance sheet, it will just magnify the need to say, yeah, I need to protect that $5 million asset. And for many people, it's double that or triple that. So kind of keep that in mind and think in terms of what is their income worth, what is their human life capital, and focus on protecting that, okay? And when we talk about protecting income, most people think, well, it's never going to happen to me. I'm healthy, I work out. Well, that's great. And they may say, well, I don't work in an occupation that is prone to accidents. Well, we get it, but accidents only represent about 10% of disabilities today. And the rest of them fall in that muscular and skeletal, mental, nervous, circulatory, nervous system, cancer. Cancer is a growing segment, as is mental nervous disorder and substance abuse. And that's the mental nervous aspect of it is growing exponentially within our market. So it's something that we have to focus on. And keeping that in mind, when people talk about, what's the likelihood of what type of things are causing disabilities, we find that one of the highest areas of disabilities for us in the female market are females between age 30 and 39. And that's from ovarian cancer, breast cancer, and obviously childbirth is one of the causes. For males, we're seeing prostate cancer and other forms of cancer and heart disease. So, it's something that we have to just kind of look at and be very realistic with your customer and help them understand that if they become disabled, what's going to happen. And I love to do this. I love to visit with brokers and their customers, and I say, listen, let's just assume today was the last day you could work for wage or profit. Let's just assume that happened, okay? Let's draw out on a piece of paper, where is your money going to come from, and is it guaranteed? And how long will you get it, okay? And so we just map it out. A lot of people say, well, I can get Social Security. Well, that's true. However, about 70% of the people who apply for Social Security today will be denied a benefit, okay? And then just clearly, the definition of disability in Social Security is not what I would call liberal, okay? You have a sickness or injury, which will ultimately and basically cause your death within 12 months. That's not what disabilities are today, okay? But as you're working and you look at your pay as your pay comes in, you have expenses, obviously, and then something in between, which is a very narrow number today, is savings. But when when you do become sick or hurt, your expenses go up, your income goes down, and that creates debt for you and your family. So, we're talking about food and housing, cars, utilities, all of these different things, saving for retirement. But then you've got added expenses like co-pays and medical costs, in-home care, home modification, or COBRA premiums. A lot of people don't realize that, and I'll explain that a little bit later when they talk about group LTD and how they could rely on that benefit only. But when you look at this is a reality of life for most people that don't have income replacement. So how does it work? Income replacement, one of the things that I've noticed throughout my 42-year career is that we as advisors make this a very complicated thing. And what we do know, in all the studies that we found and dealing with consumers, is they really only want to know 5 things. And if you can answer these 5 things and be prepared to answer them, your success will skyrocket. Okay. What they want to know is the first thing they want to know is, how long do I wait to get my money? I'm sorry for the spelling there, but how long do I have to wait to get my money? And that's the waiting period or elimination period. Most generally, we see 90-day waiting periods, okay, in most individual plans. So basically, you say, well, you've got to satisfy the waiting period. It's like a deductible in time. And after 90 days, then you start accruing benefits and you'll get your first check about the 120th day of your disability. So how long do I have to wait? You got to wait 90 days. How long will you pay me? Well, what we're showing you is a benefit, as an example. We got a benefit here that pays you to age 65. So if you become sick or hurt and you're not able to work, we're going to pay these benefits until your 65th birthday, after your 65th birthday and the anniversary date of your policy. So we're going to pay you to age 65. So the client says, okay, I got to wait 90 days. I get my money to age 65. The third question is, well, how much are you going to pay me? Well, that's a very good question. Based on your income of $100,000, we're going to pay you $5,200 a month tax-free. Okay. And that's how much your monthly benefit is. So I got to wait 90 days. You're going to pay me to age 65. I'm going to get $5,200 a month tax-free. The next question is, how do I get my money? Well, that's based on, number 1, you're sick or hurt. We all agree. Number 2, you're under the care of a doctor. And number 3, you have the inability to do one or more of the substantial material duties of your occupation, and you're not working. That's a total disability. Now, many carriers offer, as we do, what's called a residual disability rider. So what basically adds a little bit verbiage on there, or you suffer a loss of income of at least 15% of your pre-disability earnings. So if your income drops by 15% or more, we will pay you a benefit that is directly related to the percentage of income loss. So as an example, let's say you got an individual making $100,000. Their income drops to $50,000 as a result of the sickness or injury. Without regard to time or duty, it's $50,000. Now we take that $5,200 benefit and we say, okay, we're going to pay you 50% of the benefit. So now we're going to pay you $2,600 a month. So total disability, residual disability, either one, under the care of a doctor as a result of a sickness or injury. You can't do what you were doing when you became disabled, and or you suffer a loss of earnings of at least 15% of your pre-disability earnings. That's how you're going to get the money. So I got to wait 90 days. You'll pay me to age 65. You're going to pay me $5,200 a month. I have to be sick or hurt under the care of a doctor as a result of a sickness or injury. And I could be either totally disabled or residually disabled. Doesn't matter. The next question is, how much will this cost? And that's the premium. As an example, it's going to cost $100 a month. And that's what your customers want to know. You don't want to get too much in the weeds with them. Companies have a tendency to create and put this fear into most advisors that says, yeah, this is complicated. You got to know what you do. No, just tell me how long I have to wait. How long will you pay me? How much will you pay me? How do I get my money? And what's it going to cost me? Those are the things that a customer, fundamentally, they want to know that answer. And if you can master that, which is not very hard, I just gave you all the verbiage you need, then you could become very successful in the marketing of income replacement. Okay. So again, what does income provide for your customers? It provides for their daily expenses. It provides for their children's education, their car, their home, their groceries, their everything. It basically identifies who they are. You know, income, setting aside all moral things, really defines who that individual is. Not only in the home they live in, but the clothes they wear, the friends they have, the entertainment they enjoy. So help them understand the value of their income and why is it so important that they insure it. You know, there was an insurance company not long ago that came up with the motto, and it was really kind of clever. We insure the things we can't afford to lose. When you think in terms of, could you afford to lose your car? Well, for some people, no, you can't afford to lose it, okay? So you insure it. Can you afford to lose your home? No, but you insure it. Can you afford to lose your income? Can you afford not to have an income? No, can't have it. That just won't work, okay? So it's important that you emphasize with your customer the importance of income replacement. And at Principal, we could design a plan that covers you while you're disabled in your working years, and we could also help fund your retirement plan with our DI Retirement Security Plan. And it's a really a unique plan. So this is basically what happens to an individual. And when you look at, like most people will say to you, hey, I've got group benefits at work, I'm okay. Well, yes and no. It's a good foundation, I will say. So let's assume you're making $75,000 a year. You're bringing, you know, that's a monthly check of $6,250, but then after you pay Uncle Sam, you're down to $4,375. So that $4,375 is the home you live in, the cars you drive, the clothes you wear, the entertainment you enjoy. Now, if you became sick or hurt with that plan, your benefit is 60% of your pre-disability earnings, or $3,750 a month. Now, that's going to be taxed most generally because the vast majority of LTD plans are a qualified plan where the employer deducts the premium as a fringe benefit, meaning that the benefit amount, that $3,750, is going to shrink to $2,625. So now you're living a lifestyle of $4,300, but you have an income of $2,600. Something's got to give, okay? So what we recommend is supplementing that with a benefit amount, like in this case, $6,800 or $1,600, gets you to about 2% less of what you were making while you were working. Not a bad thing, okay? But let's take a look at that $2,625. Now, keeping in mind, if an individual has group long-term disability with their employer, that only indicates to me that they have a robust plan for benefits to include health insurance and 401ks, okay? Not many employers who simply buy health or long-term disability and nothing else. It's usually attached to a very robust plan. So from that $2,625, that individual becomes disabled. What was the employer paying for or subsidizing for their health insurance? So if the health insurance, let's hypothetically say it was $800 a month, okay? Now that individual has a choice. They can take through COBRA, they can pay that full $800 a month, okay? But where's that $800 coming from? It's coming from that $2,625, all right? So you have to think in terms of there's potential major shrinkage in the take-home pay when you consider that they have to pay for health care. And the other thing too is what happens to their 401k. Now, here's what's hard to believe is the majority, well over 60% of plan participants in 401ks, when surveyed 3 years ago, said that, yeah, if I become sick or hurt and I'm not able to work, my employer is going to continue to make those contributions to my 401k. I don't know where they got that information. I don't understand where they think that's going to happen. But a 401k, you think in terms of this. They may say, yeah, we'll continue your contribution, but it's a function of earned income. They're saying, let's say, making 4% contribution on a $10,000 monthly paycheck. Well, you were making 10, now you're making 0. Okay, so they're going to put 4% of zero into the 401k. It's still zero. Okay, so there's nothing going into the 401k because it's a function of earned income. And without earned income, there's no contributions being made. And so we have a plan that helps protect that through the DI Retirement Security. You can visit with the Miles and the great team at Jetter Company, our Jetter Company, to kind of get a flavor of what that means and how that works. So here's what you got. You got a disability income paying you during up until your retirement age. And then after you retire, you've got this money in a non-qualified trust that's going to help supplement your retirement lifestyle after you become disabled. So it's a pretty good deal. What do we need to help you and your customer? Number one, name, gender, date of birth, occupation, income, state of residence, and whether they use nicotine at all. Okay. And then we want to know what their medical issues are. And when I talk about medical issues, in many cases, we will get what's called a prelim. A prelim basically says, hey, listen, my customer has these medical issues that kind of cause a red flag in my mind, you as a field underwriter, okay? And as a field underwriter, you want to have a pretty good idea of what to expect, what the outcome's going to be. So we do a lot of inquiries. We do well over 1,000 inquiries a month. This is where we're getting from an advisor information on a customer based on some medications they're on, or health issues, or height or weight, or maybe sometimes financial situations, that you can have our underwriters give you what's called a preliminary assessment of what you could expect when and if you submit an application. We think that's a better deal than submitting an application and waiting to see what happens. It really has no benefit to anyone. It is irritating to go back to a customer and say, hey, you don't qualify, or they're going to give you a rider, or they're going to rate the contract. If you knew that ahead of time and you had the idea, the opportunity to maybe get ahead of this and explain to the customer, well, based on your medical condition, you're probably going to get a 25% rating, or we're going to exclude your lower back. These are things that help you when you do submit the app, and helping manage the expectation. That way, when the policy comes back and you have that 20%, 25% rating, or that exclusion on the back, everybody knew it up front. We knew what we would do. And it's very easy to submit those delivery requirements and get that policy paid for. We know that you don't need to be out there practicing filling out applications or doing e-apps, but we do know that it is something that's very important, and we find it as a real big benefit, not only to you, but more so to your customer. That way it doesn't show up on an MIB code or anything like this. So it's really an effective way to manage expectations for your customer. And the desired amount of income replacement benefit and any known existing disability coverage, such as group, or maybe a policy they bought back when they were in medical school, or whatever it may be. We'd like to have full disclosure of all that information. That way we can prepare, Miles can prepare for you a proposal that is true, accurate, and as good as it's going to get. So Miles, where'd you go? Miles, I've completed this. So I'll let you have the last word. We have 1 minute till we're done.
Well, that was fantastic. I really do appreciate the information here. You must have done a really great job explaining it. No questions popped up during that presentation there. So I really do appreciate the time you gave us here today, Rick. Folks, if you do have any questions, or like Rick said, clients that you're looking to work with, I just need that information, and I will definitely get it an illustration your way. So please give us a call or send us an email to di@jetter.com if you have any additional questions. Thanks again, everyone. Have a great day, Rick.
Thank you.